2:17 a.m. Your mouth is dry. You pad into the kitchen. Half awake, you glance at your phone, and there it is, a wall of red. Not one headline. 10. Silver is crashing. Silver is surging. Silver is limit down. Silver is limit up. It doesn't even matter which direction, because the damage is the same. Shock, confusion, the sound of the floor moving under your feet. And somewhere, in some glass tower, a man you'll never meet is smiling. Because violent markets don't reward patience, they reward the people who control the levers. Now listen, CME silver volatility is flashing red. Not mildly, not a little elevated, near triple digits. The Silver CVOL index was recently around 98, 77. That number isn't decoration, that number is a siren. Because when implied volatility climbs like that, the market is pricing chaos. A lurch, a snap, a whip. The kind of move that doesn't give you time to think. And here's the dirty secret. When markets turn violent, the rules don't protect you. They protect them, the dealers, the clearinghouses, the paper machine. You, the saver, are the one holding the bag. They trained an entire generation to think a bank statement is money. It isn't. It's permission. It's a promise. It's a digital IOU sitting inside a system that can freeze, delay, haircut, or restructure the moment the system feels threatened. And when volatility screams, that system starts cracking in places you can't see, like the Titanic. At first, it's quiet. Just a shiver in the hull, then sudden, then water in the stairwells, and people still dancing because the band is playing. That's where we are. And most people don't even know it. They're asleep. They trust the screen. They trust the brochure. They trust the experts who told them to be calm right before every major blow-up in modern history. But CVOL near 99 is not calm. It's the market telling you something is coming, something sharp, something that can get violent fast. So let's strip the fancy words off this and talk like grown-ups. CVOL is simple. It's the market's price tag on fear. CME's CVOL is a 30-day implied volatility measure pulled from options on silver futures. Translation? It's what traders are paying to protect themselves for the next month. And when that number sits near 98, 77, the market is not whispering. It's yelling. It's saying, this month could be a knife fight. Now here's the part they never explain on cable news. Volatility isn't just a mood. It translates into movement. And movement translates into damage for regular people. Because regular people don't trade for a living. They live. They pay bills. They buy groceries. They try to retire in peace. So let's do the math they avoid. Volatility is quoted like an annual number. But you can approximate a 30-day expected move like this. Expected 30-day move price, X volatility X, 30,365. No PhD required. Let's use easy numbers. Say silver is $80, volatility about 99%. The square root part is about 0, 286. So the expected one standard deviation move is roughly 80x0, 99x0, 286. About $22. In a month, $22, that's not a normal market. That's a casino floor right before the lights flicker. And when the lights flicker, the house changes the rules. That's what exchanges do. They call it risk management. They call it market stability. But the result is predictable. They tighten the screws. They raise margin. They demand more collateral. And that forces liquidations, not because you were wrong, because you didn't have enough cash sitting around to satisfy the machine. Weak hands get wiped. Regular people get blown out, and insiders scoop the wreckage. This is not new. It's how the paper game is designed. And the CME has been hiking the cost to trade silver. Reports noted margins rising to around 9% of contract value, up from roughly 2% not long before. That's a big jump. And it matters, because margin is the oxygen of the futures market. Raise the margin, and you choke out smaller players. Raise it fast, and you create forced selling. And there was another shift that should make you sit up. CME moved precious metals from fixed dollar performance bonds to percentage of notional requirements. That sounds boring. It isn't. It means as the price rises, the required margin can rise automatically. Translation? When silver starts moving, the system gets tighter. When the system gets tighter, forced selling increases. When forced selling increases, price swings get sharper. It feeds on itself. A loop, a blender, a machine that turns human emotion into profit for the people who built the machine. Now here's where retirees get trapped. Because you were told you have safety nets, FDIC, government backstops. Don't worry, we've got you. Listen carefully. FDIC insurance has a standard limit of $250,000 per depositor, per bank, per ownership category. That's the headline. But headlines are not the experience. The experience is the line, the delay, the forms, the temporary measures, the feeling of being treated like a number. And here's the uglier truth nobody likes to say out loud. When a system is stressed, procedures change. They don't ask your permission. They don't hold a vote. They use emergency language. They do what protects the system first. You last, always last. This isn't a theory. This is math, because the system is built on promises, and promises fail under pressure, especially when the pressure is rising right now. Silver has been making moves big enough that even mainstream outlets talk about steep plunges in exchanges raising margins in response. That's not an accident. It's a symptom. So ask yourself one simple question. If the paper price of silver can swing like a wrecking ball, what does that say about everything else priced in paper? Your savings account, your pension calculations, your bond fund, your balanced portfolio. All of it floats in the same digital ocean. And when the tide pulls out, you find out who's been swimming naked. Now we get to the trap. Because volatility doesn't just happen. It's a signal, a flare, a warning that the system is losing control. And when the system loses control, the system reaches for more control. More rules, more monitoring, more limits, more temporary policies that somehow become permanent. Imagine this. You pull up to a gas station. You slide your card. Declined. Not because you're broke, because your bank has temporary restrictions. They call it fraud prevention. They call it system integrity. You call it what it is, a leash. Imagine this. Your pension statement arrives. The number looks fine, but the grocery bill is up again. Your property tax jumps. Your insurance premium jumps. And suddenly that fixed income feels like it's shrinking every month, like a sweater in hot water. Imagine this. You decide to move some money just to be safe, just to diversify, and the transfer hits a wall, a review, a delay, a new policy. Because in stress times, money doesn't move freely. It moves with permission. That's the trap. And silver matters because silver sits at a crossroads. It's industrial, it's monetary, it's emotional. Silver is a thermometer. It picks up the heat before the fire is obvious. When silver starts moving violently, it tells you the market is confused about the future. Rates, inflation, recession, currency strength, war, debt. It's all in there. And when that confusion spikes to the point where CVOL is near 98, 77, the market isn't whispering. It's yelling. Now watch what the system does when fear rises. They don't reduce risk for you. They reduce risk for themselves. They raise margins. They tighten credit. They adjust rules. They herd people back into paper because paper is where they have the switches. And if this keeps spiraling, the push toward digitized control gets louder. Because digitized control is the dream. A world where every transaction is tracked. A world where spending can be limited, programmed, allowed, denied. A world where the system can say, not today, not there, not that. A world where money stops being money and becomes a remote control. And here's the problem if you're 55 or older, you don't have 30 working years to make it back. You have a runway, a finite number of healthy years. And volatility is wind shear. It can knock your retirement plane out of the sky in one bad month, one forced liquidation, one unexpected policy, one temporary restriction. And suddenly the life you earned becomes a smaller life you didn't choose. This is how it happens. Not with one big announcement, with 100 little cuts, a fee, a delay, a restriction, a rule change, a new definition, a new form, a new limit. And when volatility is near triple digits, that's exactly the environment where rule changes happen fast. Because they always do. When the building starts smoking, they lock certain doors. Not to save you, to control the crowd. Let me give you a picture you can feel. Paper silver is like a photo of a lifeboat. It looks reassuring. But when the ship tilts, a photo doesn't float. You need the actual boat. There's silver on screens. And there's silver in your hand. Most people don't learn the difference until the day the difference matters. Because in a real panic, settlement becomes a negotiation. Delivery becomes inconvenient. Inconvenient turns into delays, special procedures, and rule changes. Always for your safety, of course. Always for stability. That's why the word counterparty matters. Because when you own a claim, you own a dependency. You depend on the light staying on. You depend on the promise being honored. Now think back. You've seen this movie, the 1970s. Prices climbing. $1 that bought less every month. You were told it was temporary. Then you looked up and realized the world had changed. Then, 2008, the experts said the system was safe. Then pillars cracked. Names you thought were untouchable vanished. And regular people got the lecture, while the insiders got the rescue rope. That's the pattern. Us versus them. The awakened few watch the plumbing. The sleeping herd trusts the headline. And volatility is plumbing. It's pressure in the pipes. When CVOL is near 98, 77, the pipes are screaming. Now imagine this. You wake up to a banking holiday. Just a day, just a precaution. But you still need gas. You still need groceries. And the clerk shrugs. System is down. Imagine this. Your credit card limit gets cut. Not because you missed a payment, Because the issuer is reducing exposure. Translation, you're the exposure. Imagine this. Your brokerage app still shows a number, but you can't sell when you want. Or you can sell, but the proceeds are pending. And pending becomes days. Days become weeks. Meanwhile, bills don't care. Life doesn't pause. That's what volatility does. It turns assets into maybe. Retirees can't afford maybe. And inflation? Inflation is the quiet thief. It doesn't kick your door in. It picks your pocket, month by month, until your grocery cart is lighter for the same money. That's why hard assets matter. Not to gamble, to preserve, to keep options. Physical metal isn't magic, but it removes a layer of dependence. And dependence is what gets exploited in a crisis. If you depend on their permission, you live on their schedule. If you hold something real, you live on your own terms. And when volatility hits, physical shelves can tighten even if paper prices whip around, dealers run low, premiums jump, and the person who waited for a better price finds out the lifeboats are gone. That's why preparation beats prediction. You're not trying to call the exact bottom. You're trying to avoid scrambling when everyone else is scrambling. Because the stampede is when the system shows its teeth. Don't miss this. The system loves complexity. Because complexity hides risk. A retirement account statement can look diversified and still be one giant bet on the same thing. Paper, promises, counterparties, different labels, same cage. Physical metal is simple. You can count it. You can hold it. You can store it where you choose. At home is safe, a private vault, your call. No app update, no password reset. No, we're experiencing unusually high call volume. Just ownership, quiet ownership. And quiet ownership is what separates the prepared from the panicked. So what's the exit? Not a stock tip, not a hot trade, not a spreadsheet fantasy, something older, something real. Physical metal, gold and silver, not as a get-rich plan, as survival, as freedom, as the right to step outside the paper maze. Because physical metal has a strange, beautiful feature. It doesn't need permission, it doesn't need a password, it doesn't need a bank's approval, it doesn't need a clearinghouse to settle. It's a bearer asset. If you hold it, you own it. And ownership is the whole game. Because the biggest risk in modern finance isn't price risk. It's counterparty risk. Say it slow. Counterparty risk. That's the risk the person on the other side can't or won't pay you when it matters most. Your bank is a counterparty. Your broker is a counterparty. Your pension administrator is a counterparty. Your safe paper product is a counterparty. Because paper is a claim, a promise, and promises break under stress. Physical metal? No counterparty, no CEO, no board meeting, no bankruptcy judge. It just exists. That's why the system hates it. Because it's outside their rails. It's a lifeboat that doesn't require their permission. Now connect the dots back to the warning. Silver CVOL near 98. 77 is telling you the paper-silver market expects chaos. And when chaos hits paper markets, paper rules get rewritten. But physical is simple. Weight, purity, possession. That's why the phrase matters. Be your own central bank. Because central banks don't store wealth in promises. They store it in reserves, hard assets, things you can't print, things you can't pause, things you can't update with a policy memo. Now, does physical silver move in price? Yes, it can be violent. That's the point. Volatility is not your enemy if you own the right form of ownership. Volatility is your enemy when you're trapped in paper and forced to sell right when the machine tightens the screws. That's why retirees get hurt. Not because they're wrong, because they're stuck in the wrong vehicle at the wrong time. A paper vehicle. A leveraged vehicle, a vehicle that gets margin called when fear rises. And we've already seen how quickly the exchange can raise the cost of staying in that vehicle. So here's the mindset shift. Stop thinking like a trader. Start thinking like a survivor. Traders chase moves. Survivors build lifeboats. Traders measure success in monthly returns. Survivors measure success in sleeping at night. And if you're in the 55-plus crowd, you already know something younger people hate admitting. Time is precious. Peace is precious. Your life savings is not a toy. So here's the core idea. Physical gold and silver reduce dependence on the system. They reduce exposure to counterparty risk. They reduce the chance that a digital glitch, a bank restriction, a policy shift, or a market freeze traps you in place. Does it solve every problem? No. But it solves one massive one. It puts ownership back in your hands. And in a world where rules change overnight, ownership is everything. Because when the casino panics, the casino locks the doors. But if you already stepped outside, you don't have to beg. You don't have to wait. You don't have to hope the system works. You hold something real, something recognized, something that has survived every government decree in history. And that's why when volatility flashes red, the smart move is not to panic. The smart move is to prepare, quietly, before the crowd wakes up. Because when the sleeping herd finally realizes what's happening, they all run for the exits at once. And exits are narrow, Dealers run low. Premiums jump. Delays happen. And suddenly the lifeboats are gone, and you're still on the deck watching the water rise. Imagine this. It's a year from now. Prices are higher. Rules are tighter. Markets are wilder. Your neighbor's angry and confused. He says, "How did this happen?" And you realize it wasn't one thing. It was 1,000 signals. And one of those signals was this: silver volatility near triple digits. A flare in the night sky. A warning. Most people ignored it. You don't have to. If you want to survive what's coming, subscribe to Economy Meets History. Because the people who make the rules count on you staying asleep. They count on you trusting the screen. They count on you believing your life savings is safe because a brochure said so. But volatility doesn't lie, and math doesn't care about feelings. So here's the thought to leave you with. When the storm hits, you don't rise to the level of your hopes. You fall to the level of your preparation.